Not to be overlooked, consumer sentiment this morning jumped to its highest level since last January, rising nearly 16% from last month's quite low reading. Now, the upward tick also comes as the inflation readings are getting better, and their consumer fears over higher inflation is beginning to ease. Our next guest, though, says this is something to keep an eye on as we move into the back half, and you might think especially now so with oil prices. Let's bring in Chris Senyek. He's Wolfe Research's chief investment strategist. Chris, do you have any thoughts about the sort of top-level Iran-Israel situation as well, now that we have to ponder it, and how drawn out this might be, what it might mean for gasoline prices, and the fact that the market is not totally, but sort of shrugging it off?
Yeah. Hi, Kelly. Thanks for having me on. So, history suggests that market reactions to these types of conflicts are short-lived, whether it's a spike in oil prices or a drawdown in the market. That's assuming that there's not a long, drawn-out conflict, and our base case is right now that there isn't. However, there are tail risks, right? That if we shut off Iranian oil production, they block the Straits of Hormuz, or some other action, or just it escalates into a broader conflict, then that takes a lot off the table. The good news, I think, however, with oil prices is I think they're capped here because OPEC Plus has a good amount of spare capacity. We have the Strategic Petroleum Reserve, and rig counts in the U.S. have been trending down, and because of higher oil prices, they'll likely trend up over the coming months. So I don't think oil prices go a lot higher from here, but we're not going to have the tailwind that we did to inflation over the summer months that maybe we thought we would previously before this conflict.
You're almost a reverse. So you would be a seller of energy on this move here, but you're more, shall we say, bullish. You fear or foresee that inflation broadly could move higher in the second half. A lot of people are now putting that one in the rearview mirror after the string of better reports we've had.
Yeah, so oddly enough, we have this very benign inflation reports, whether it's the PPI or the CPI this week or more recent data, but it feels like that's going to be a head fake in our minds. We haven't really seen the impact of tariffs in the data. Some of our checks indicate the companies are just starting to put price increases through in June and July. And some of the data in the reports this week, whether it's used car prices or airline fares, we think are proved to be transitory. We think we're going to have a reacceleration in inflation in the second half of the year. That could cause the Fed to not really cut at all and put upward pressure on bond yields. And that doesn't even assume that oil prices go higher from here. We're not even assuming that. The most concerning aspects of some of these surveys, if you look at the ISM services prices paid component recently reported, that's been trending up, and the same thing for the regional survey. So I don't think it's just goods, Kelly. I think it's services as well. And that's a problem for the Fed and for the inflation numbers. It's just a little early. We're not seeing it yet.